The 10 key differences between debt and equity. Capital is the basic requirement of every business organization to fulfill the long-term and short-term financial needs. To raise capital, an enterprise either uses owned sources or borrowed ones. Owned capital can be in the form of equity. Borrowed capital refers to the company's owed funds or debt. The 10 key differences between debt and equity. The difference between debt and equity capital are represented in detail in the following 10 points. 1. Debt is the company's liability which needs to be paid off after a specific period. Money raised by the company by issuing shares to the general public, which can be kept for a long period, is known as equity. 2. Debt is the borrowed fund while equity is owned fund. 3. Debt reflects money owed by the company towards another person or entity. Conversely, equity reflects the capital owned by the company. 4. Debt can be kept for a limited period and should be repaid back after the expiry of that term. On the other hand, equity can be kept for a long period. 5. Debt holders are the creditors whereas equity holders are the owners of the company. 6. Debt carries low risk as compared to equity. 7. Debt can be in the form of term loans, debentures, and bonds, but equity can be in the form of shares and stock. 8. Return on debt is known as interest, which is a charge against profit. In contrast to the return on equity is called a dividend, which is an appropriation of profit. 9. Return on debt is fixed and regular, but it is just the opposite in the case of return on equity. 10. Debt can be secured or unsecured, whereas equity is always unsecured.